Welcome to Efficient Tax's video on highest justifiable price. We're going to go over the meaning of highest justifiable price and how it can work for you. In this video, you're going to learn the definition of highest justifiable price, how it works, and all of its capabilities. By the time this video is over, you will understand the advantages of using this feature. We're going to start with defining highest justifiable price. The use of a highest justifiable price rests on the premise that every stock or tax lot has a price in which it makes sense to sell, pay the tax, and reinvest the remainder, even if an investment is held less than 12 months and is subject to a higher tax rate. This feature can come into play when a tax lot is still within the 1-year short-term higher tax rate window. It is assumed that tax lots that are above their highest justifiable price are especially vulnerable to falling back down to that price at any time. To be conservative, Efficient Tax assumes that price drop could happen as early as the next day. Because of the material impact that the inclusion of a highest justifiable price can have on a sell decision, and the potential that a recommended sale could generate higher taxes, this value should only be used judiciously and with care. Therefore, a highest justifiable price is always defaulted at a level of 125% of the current delayed market price in order to eliminate its impact on a sell decision. Unless a user deliberately saves a value they feel comfortable with, or a user is incorporating dynamic capital management's expectation sets as their primary price targeting source, limiting the system's ability to use a number by accident. DCM does fundamental equity valuation research on more than 600 of the most widely invested stocks, including that of a highest justifiable price. Now let's take a look at how highest justifiable price works, in an example where a stock's price is high enough to justify a sale in the short-term window. Let's say that 10 months ago you purchased a stock for $50 a share and it's now valued at $120. However, the highest justifiable price for this stock is only $80. Meaning that by looking at various measures of valuation like PE ratios, price-to-book values, return potentials, and other metrics, the stock is trading at about $40 above the high end of its historic valuation price range. Efficient Tax will calculate whether you should sell now at the $120 share price, pay the short-term higher tax rate and reinvest, or hold on to the stock until the long-term lower tax rate has been reached, assuming it will have already dropped back down to the highest justifiable price at $80 before then. Which is better? If an investor is likely to lose more value on an after-tax basis resulting from a price drop, then they're likely to save in taxes by waiting until the long-term window, compounding effects included out to the end of a chosen investment horizon, an investor should consider selling even in the short-term window. This circumstance occurs more often during stock market bubbles. Now we'll look at a graph to help visualize all of this. The blue dot on the upper left-hand corner is the current market price. The red dot below is its highest justifiable price. The blue line is the before tax market value of a currently owned tax lot drawn from its highest justifiable price out to a forecasted price over a 4-year investment horizon. Now here is the yellow after-tax value line equivalent of the blue current holding market value line, starting on the left at the stock's current after-tax value at current prices, dropping down immediately, reflecting the after-tax impact of a dramatic price reduction. We first calculate what an investor is forecasted to have at the end of a chosen investment horizon if they sold an overvalued stock today. We're able to pay the higher tax and reinvest the after-tax proceeds at a reasonable rate of return. And compare that to a projected after-tax value if the investment is not sold until it achieves the long-term tax window, having dropped to its highest justifiable price before that. You will notice that the green line on the graph shows the after-tax value over time if a stock is sold at its current price, with its current after-tax value being reinvested. And that is compared with an assumption that the price drops to its highest justifiable price tomorrow, represented by the red dot, and then tracks up to its end-of-horizon price target, where an after-tax value is calculated on day 366 of ownership, the day it goes long-term, with it being sold with its after-tax proceeds reinvested, represented by the red line. As you can see, the green line ends at a higher position, indicating that selling in the short term, in this case, is forecasted to add significantly to after-tax returns. So, if an investor is likely to lose materially more on an after-tax basis due to a potential price drop than they're likely to save in taxes by waiting until the long-term window, a short-term sale should be considered. So again, if efficient tax calculates the investor would be better off by selling at the higher tax rate rather than holding until the lower tax rate, the investor should consider doing so, with the investor likely to wind up with more after-tax wealth over time. Well, that's a quick overview of highest justifiable price. Over the past few minutes, you've learned the definition of highest justifiable price, how it works, and all of its capabilities. The highest justifiable price technique has enormous value for its users. Its whole purpose is to determine which decision will end up with the greatest after-tax wealth. Thanks again for watching, and good luck in the markets.